Today is Friday, September 22nd, 2023, and we had a very exciting week with the Fed meeting. So let's jump right in. All eyes were on Fed Chair Jerome Powell this week as the Fed announced a pause on rate hikes for the month of September and raised expectations of where rates might be in the next year or so. Ultimately, this spooked equity investors as the Nasdaq Composite fell 3.5%, the S&P 500 fell 2.8%, and the Dow Jones Industrial Average fell 1.6% as of close on Thursday for the week. Right into our news of the week, the most important update we had is the September Fed meeting. So lots of changes in how rates will be in the next year or two, and we will jump right into that here. So out of the 8 Fed meetings that happen each year, only 4 bring us a really important summary of economic projections, or SEP for short. So that's really important. Shows where the Fed head is at in terms of where they think GDP is going to be, where they think unemployment is going to be, inflation, and then most importantly, where they are going to their best guess of where rates are going to be in the next year, 2 years, etc. You can see here the expectations of where rates will be has been largely unchanged from the June projection in the 2023 rates, insinuating one more rate hike here for the end of the year, either at the November or December meeting. Then you can see as we look out to the next year to 2-year time horizon, that changed quite a bit from last meeting. It used to be a 4.6% Fed funds rate at the end of 2024 expected on a median basis from the Fed members. Now it is 5.1. Then in 2025, you can see here a 3.4% expected Fed funds rate in June, then is now 3.9% for where they think rates will be in the end of 2025. So basically, going to hold rates for longer depending on economic conditions, and this was a really important update from the Fed. Also from the SEP, we get this dot plot, oftentimes referred as kind of the most important part of the SEP. You can see here where the FOMC participants believe the appropriate monetary policy rate is for the Fed funds rate. So here you can see some of them are in this range. I think about 7 out of the 19 voting members here are in the range of the 5.25 to 5.5% rate, while a majority of them, I think 12 out of 19, are above the current level. So 12 out of 19 think that there is still a rate hike to come this year. We get a little bit of a different story when we look at what the market is pricing in for rates through the end of next year, basically through the December Fed meeting. Here you can see 57% think they're going to stay the same through the end of the year, even though a majority of Fed members have indicated they want to raise one more time. And 36% say that it's going to be 125 basis point rate hike, and 5.6% say it's going to be 50 basis points of rate hike. So whether that means one big rate hike or 2 smaller rate hikes at the next 2 meetings, we will see. But just really interesting to see how, even though we just had this Fed meeting and the market should be updated on what the Fed funds rate should be through the end of the year, the rate probabilities are not exactly matching that. So really interesting stuff. We will continue to monitor to see what the Fed is up to in this very Fed-centric economy, along with all of the economic data that they're also looking at and making their decisions. Moving into some more economic focused data, the LEI, the leading economic index, fell 0.4% in August to 105.4. So you can see that here in the LEI. It's been hovering down at this lower level for a few months now, so definitely a very bearish sign. The main reasons for it moving lower in August were lower consumer expectations of business conditions, along with lower new orders and a continued inversion of the yield curve. So that was kind of the bearishness that led in August. So you can see here, definitely on a downward trajectory. And that is not a good sign. Historically, the LEI has been pretty accurate in predicting the early 2000s bubble, as well as the Great Recession of 08, 09 time, as well as even the COVID mini recession there. So really important data point to look at as we get a view on the economy. Also this week, we got some real estate data on existing homes, where we saw the market for existing home sales continue to appear quite stale as August existing home sales data showed a very sluggish outlook. Sales totaled 4.4 million, down almost a percent from a month ago here, and this was also over 15% of a decline since last year. So quite a bit of a drop in terms of volume. We saw inventory on the market slightly longer, and also the median sales price has actually increased, which is really unique. It's increased almost 4% from a year ago to $407,000 for the median sales price. So really interesting stuff given that we have such higher interest rates. We haven't seen a huge impact on home prices, and that's because people are staying in their homes longer than they may necessarily have wanted to with the higher interest rates and higher prices. So really interesting stuff to see how it'll play out. Final data point, wanted to take notice of this week. Despite the slightly higher unemployment rate we saw in August at 3.8%, weekly initial claims data is continuing to move lower. So you can see that here. It's really been on a downward trend since a little bit of a higher level in June, July timeframe. So hiring kind of slowing, but those large scale layoffs seem to be a thing of the past, thing of, late 2022 as companies were trying to beef up their earnings and make their financials look a little bit healthier in the face of a potential economic slowdown. But looking at this week's data, the initial claims for the week ending September 16th here came in much lower than expected at 201,000 claims. So this is really low compared to where we've been over the last year or so. And this has been, again, like a downtrend really since the summer of really strong labor market data that is confusing investors because some economic data points are blinking red and some are blinking green like this. We have a really strong labor market still, and we will continue to monitor all of this data really closely just to catch any shifts in the market. So, amidst all of this economic data, we are continuing to be cautiously optimistic, part bull, part bear, in the face of this new information from the Fed, as well as all the other economic data that we look at throughout the week. So, just wanted to say thank you, and we will see you next week.